Start off this presentation by just going over some key points before I get into a lot of the details. And again, going back to the title and the focus of the presentation being in the world of technology economics and the importance of software process, I just want to introduce you to the field of technology economics. And this is a rather young field. Everyone on this call, plus myself, seems to have a right to invent in this field because it's really not very well known about the impact totally of technology in business. If you go back in time, before 1960, really did not have computing in business. So in fact, we're looking at an era that's, little more than 40 years old, while historical accounting and business principles have gone back, as you'll see, more than 10,000 years. So in fact, when we start talking about technology economics and the role of software process, we're talking about something that's recently born, recently looked at, and something where theories and binding principles are first starting to be developed. So when I talk about some initial key points on panel number 5, and I talk about the notion of technology economics, just to step back, and a lot of today's presentation has to do about patterns and getting insights from patterns. So what I did here is I took a look at the U.S. Dow Jones Industrial Average, the U.S. Gross Domestic Product, and what's happened is IT spend as a percent of revenue relative to 1960. This chart is really what we might call a chained index. So we use 1960 as our base point, and you look at what's going on this particular chart. You see a line sort of in the middle, and that's our GDP nicely rising, and there's a line on the bottom, and that sort of zigzags around. That's watching the Dow Jones through 2006. I haven't done the year-end 2007 stuff because we're in a highly volatile year, as you hear about shortly. And actually, if you start to look at that line on the bottom, and you look at the line on the top, you'll see lots of similarities. And the line on the top really has to do with IT spending versus revenue, and IT, what we might call IT intensity. The thing I'd like you to observe on this chart is it's very subtle, but if you look at the GDP line, it has this era of mainframe computing. It has sort of a slope, very low percentage, sort of rising to the right. You go to distributing computing area, you see there's a little lift in the slope of that line. And you see all the way on the right, sort of the Internet pervasive computing area, the GDP slopes a little bit further up. If you go back to this talk of Alan Greenspan and other economists, you'll hear a lot of talk about the lift that technology is given to productivity in the economy. And you can start to see this as the line sort of changes. The other interesting thing in this pattern, if you watch the Dow Jones line on the bottom, which is sort of like an EKG, and you look at the technology spend as a percent of revenue line relative to 1960 on top, you notice the patterns follow. So just interestingly enough, in terms of big observations of technology economics, 3 interesting little points here. Point number 1 is it looks like there's some interplay between technology moving into business and becoming more pervasive over time and uplift to the GDP. That's one piece. Number 2 piece that's sort of interesting here is that technology spending seems to follow what's going on, and using the Dow Jones as a sort of a barometer here, following the condition of business. In up economic times, IT spending goes up, and down economic times gets squeezed. Shortly we'll hear in terms of economic theory why that might be the wrong reflex. But if you just take a look at the bottom bullet over here, is the percent spend on IT has increased 7-fold since 1960. So IT intensity is just increasing in business. And you have to think, where are the dollars going in IT? Well, clearly they're going for the infrastructure that runs the applications. But where they are also going is for the applications that is making the demands to run the infrastructure. So in fact, and this is where we're going to start to see software process comes in, because software process is the foundation of being able to build effective and efficient systems that contribute business value. If we go up to the next set of key points on panel number 6, just to think about a couple of the statements I made before, we're starting to get this history built up, so we're entering an era in which technology, economics, and business can be understood. And in fact, if you start to take a look at the most technology-intense industries like financial services, and you'll see shortly, that's number 1, where companies could be spending up to 10-12% of revenue and 15, 18, 20% of operating expense on information technology. It becomes absolutely critical for companies to understand the yield of their investments. So it's likely that companies that can master technology economics will have an extreme competitive advantage in the short term. Again, the principles of technology economics, technology yield are just not well understood. They're first being observed in the long term. So companies that can master those quickly can turn their technology efforts into high yield investments for them. And in fact, the point I made before is that when we talk about technology economics, you'll see about at least half of every IT dollar is being spent on software systems or support of those, and the other half or less is going into the infrastructure. So technology economics itself is a powerful backdrop to understand the importance of software process, because software process and rigor in software process is the basic tool of ensuring that you meet the requirements, that you deliver what's needed to the business, and increasing overall yield of technology investments. If we move up to the next panel, number 7, and we'll get some more acuity on the notion of technology spend on development and maintenance activities, is again, as I said a moment ago, 40–50% is being spent on those activities. So clearly the ability to focus technology dollars on development and maintenance is important, but if you think about what's going on in business, as technology becomes more critical to business and we're building up this application portfolio and systems, you'll see shortly this tremendous demand on growth on the infrastructure. Now, businesses themselves do not have infinite technology budgets. They just can't keep spending and spending and spending unless in most economic models within a business. So, in fact, as demand for infrastructure is increasing, and financial services, again, is a wonderful example of this, and we're going to use the bellwether. And, compliance and regulatory demands are there, and corporate social responsibility is hitting everyone around the world. So, in fact, a lot of dollars are going toward building up the data centers, the infrastructure, the server farms, companies like Google with 1 million or more servers out there. So if you don't have an infinite budget, as you have to pump more into infrastructure, it makes the ability to spend dollars on development and maintenance even more scarce, and that's why application development and maintenance are being squeezed. So therefore, it's more critical than ever to be able to produce applications that have high yield. You're able to support more for less. And again, as I said before, the software process notion is a critical enabler, because we're really talking about applications yield and producing high quality, efficient cost structure, high performing systems. And if you wanted to get an idea of what I'm talking about, and maybe we can categorize all this as sort of the big squeeze, and the big squeeze again is about the lack of infinite IT dollars and the growing demands of infrastructure. What I produced here on the panel that's labeled 8 is just showing absolute spending growth, using a large organization with $1 billion technology budget, and showing where the money is going in finance administration or application development and data network or desktop, or application support, help desk, or voice network and data center. And if you look at the chart, the area that's sort of the growth that we're seeing over there is that the infrastructure, the basic plant of IT to run the applications has grown 30% since 2002 in absolute terms. And the distribution of spending is most definitely shifting. If you look at the top, a company that was spending $180 million on this $1 billion on their infrastructure, 18% in 2002, is likely spending almost $300 million coming out of 2006. The most interesting thing at this point in time, and I said we don't have the 2007 data overlaid on all this yet, the most interesting thing is now with the current global condition, the markets in crazy flux, as you can see every day, even just watching the U.S. Dow Jones, is companies are now starting to be very careful about their IT spending. So when I make the statement that, in fact, that you don't have infinite money to pour into IT, if you start taking a look at spending projections for 2008, as companies are becoming more and more cautious coming out of 2007, where we used to see double-digit from 2002 to early 2007, double-digit increases in IT spending. And again, financial services, which is a bellwether, might be talking about 15% increase in spending or more. We're starting to see those numbers drop by half. And part of the big squeeze is on. If the big squeeze starts and infrastructure is growing, infrastructure, again, to process the transactions as companies become more digital, they have no choice except to be able to keep up with volumes. So the application side might be squeezed. And this becomes a little more visible